So you may have noticed on that last exercise that we ran into a bit of a problem. And that problem is at time 0, we have negative cash, right? We're negative $400. So we need to figure out a way to make sure we don't have negative cash, because that does not work in a business. So one thing we haven't incorporated into our model yet is the idea that we can buy things on credit. So in our example, we're selling candy, right? When you go to the store to buy it, say you're going to Costco, how do you buy that candy? One option is you have the cash and you put the cash down and you get the candy. Another option is you use a credit card. If you use your credit card, you don't actually have to pay that bill for a little while. This is very common in businesses. Often they will essentially buy on credit, whether it's explicitly a credit card or it's the fact that their supplier expects payment, say, in 30 days. But in either case, we're always thinking about accounts payable. How much do you owe to the vendor who supplied you with your materials? In this case, again, Costco selling us candy. So what we want to be able to do is add that source of liability, right? And accounts payable is a liability. It's a debt that we owe to somebody else. Add that to our spreadsheet and see how it affects our financial statements. So what I'm going to do here is I'm going to come down to my liabilities in owner's equity side, create a little bit of room, and we'll add in some new accounts. I'm just going to go ahead and take some of the formatting we already have here, and we're going to rebuild it and make it work for us. So we're going to call this our total current liabilities, and we're going to add in accounts payable. Obviously, our formulas aren't going to quite work, so we'll rebuild those as well. So accounts payable, what are they? Again, it's how much that we owe to somebody else for what we bought. So in this case, our purchases are going to drive our accounts payable. So we can take our purchase amount, which is going to be our inventory purchase units, times the cost per unit. And now I've added an additional parameter. In this case, my input is credit card use for purchases. So I want to use my credit card 100% in this case. So let's go ahead and use 100% credit card use. And that makes our accounts payable go up by $400. Our current liabilities, well, all we have right now is accounts payable, so we can just set those equal. And let's go ahead and copy this over. And now we have to, let's go ahead and just update it so we have it working for our period 1 as well. In period 1, well, we're going to go out and buy units again, but instead of buying 200 units, we're now buying 1,000 units. So let's adjust for that. And implicitly here, we're assuming then that we pay off this $400 in the first period, and all that we owe at the end of this, at the end of the first period, all we owe is this 2,000 that we purchased during the period. So we have our accounts payable built. However, that's not yet flowing into our equity and liabilities. So here we have to update our formula. Now it's retained earnings plus current liabilities. So let's pull that in. And you'll see when we do that, we instantly get a reaction on the asset side. By making liabilities and equity 400, total assets became 400, which made current assets 400, which allowed cash to now be 0 again, right? Cash evened back out at 0. We've basically fixed our cash shortage problem by buying on credit instead of using cash. Now, if we make that same update to our first year projections, we can see how that updates. And we can see that we actually now have, I overwrote our retained earnings. That was my mistake. Let's add that back in. Again, retained earnings is whatever you had last period plus the new net income minus any dividends. We don't have any dividends right now. So now we see the reaction where because we're buying on credit, we get to keep more of our cash, and so our cash balance went up. So importantly, when that liability goes up, the asset side has to go up as well. And because the only thing that we're solving for or plugging for at the end is cash, that means when liabilities goes up, cash goes up with it. Alternatively, if our liabilities go down, that means cash also has to go down. Now, the flip side of accounts payable is accounts receivable. Right? Accounts payable means we want to borrow on credit from our suppliers, but our customers might also feel similarly. They want to buy on credit, and they'll go ahead and pay us later. So we have to build that into the model as well. Let's put in our accounts receivable. So if we come back up here, let's go ahead and make a little room for our accounts receivable. I'll put it right between our cash and our inventory. Making a little bit of room here. And we'll add accounts receivable. Now accounts receivable are going to be based on our sales, right? We have to have some parameter, right? For example, we have our credit card use sales of 20%. And so we can base whatever we sell that period, a portion of it will be on credit card or some other form of credit. But to solve for that, we can just take what our net sales are times our credit card use. So at the beginning at time 0, well, we don't have any. Let's actually make that formatted nicely with our, same as our other format. And now if we copy that over to time 1, now we see that we actually do use some credit. Now importantly, nothing balances yet because I haven't built this into my formulas. So let's go back in here. We have our sum, that's working, but now our cash, we have to be careful to now also subtract the additional asset we have, accounts receivable. So again, I'm taking my total assets minus my inventory minus my accounts receivable, plugging for cash, and now my spreadsheet balances once again. So let's set that all equal to each other. And now we can see what changing accounts receivable does to our cash position. And let's do that by changing our parameter over here. So say no one uses credit cards. If this is 0%, accounts receivable goes down and cash goes back up. Now importantly, because accounts receivable and cash are both assets, they're both on the same side of the balance sheet. So if one goes up, the other has to come back down. So if we see, for example, accounts receivable goes up because we say there's 100% credit card usage, our cash has to go down to compensate. In this case, it goes a little too far, telling us that as a business, we can't do 100% sales on credit. Something like 20% seems more reasonable and leaves us in a nice, healthy cash position.